In this example, we're going to do problem PF6-33B, and basically this is going to ask us to go through the three kind of main inventory cost accounting methods of FIFO, LIFO, and weighted average, and compare the results and see which one achieves a certain objective. And so let's start with the first one, which is FIFO. So there's going to be a series of transactions, it looks like, and we're going to use this table, our familiar table here, to fill in the details and kind of keep track of our inventory cost as we go down these different transactions. So let's start with the first one. So to be honest, it looks like the dates are a little messed up. It's not quite corresponding, but I guess we'll have to use our judgment here and figure out what they're trying to do. So again, this is another quirk of it's MyLab. Sometimes it makes errors. So on January 2nd, it looks like it's asking us about a purchase transaction. So I'm assuming that it's this January 5th transaction. And so we'll just continue on assuming the dates here actually correspond to these where they've left spots to be filled in. So before we begin with the transactions, I think we have to start with filling out our starting inventory balance. So it says we have 90 crates and a total cost of $5,850. So we would have 90, 5850, and our per unit cost, if we do the math, 5850, 90, we're going to divide the total cost by the number of units, and you see that it's $65 a unit. And so that's our starting point. So now let's go to this first purchase transaction. So we're going to buy 130 units at $76 each. And so when we do that math, okay, so now remember with FIFO we have to keep track of the different layers of inventory. So we have this initial $90 at 90 units at $65 a share, $65 a unit. And now we have this new one of 130 units at $76 for a total cost of $9,880. So the journal entry for this would only have this number, right? We would have merchandise inventory being debited for this amount, and then however we purchased it, cash or accounts payable, would be the credit. So this table is just to keep track of the number of units in the different layers. The journal entry is going to be just dependent on this total cost. Okay, so now let's continue on with our first sales transaction. So it looks like we're selling 140 crates. So now we have to ask ourselves which system we're using, because we have these 90 at this price and these 130 at this price. So which of these are we going to make, or rather how are we going to take different amounts of each of these layers to make this 140 crates that we're selling? So under FIFO, it's first in, first out, meaning we start with the oldest layer. So we're going to try to take as many of these 140 crates from the oldest layer first. So this 90, we're going to take all of them, and then the remainder, 140 minus 90 is 50, we're going to take from this next oldest layer. Since we only have two, we're going to take all of them from this oldest one and then 50 from this next one. So 90, 50, total of 140, and we're taking 90 from the $65 layer and 50 from this $76 layer. And so when we do this math, we get 5850, and this 50 times 76 is 3,800. And so when you add these two together, this 5,850 and 3,800, we get a total cost of goods sold for this transaction of 9,650. So again, in the journal entry that we do for this sales transaction, we are going to use for our costing of inventory, the cost of goods sold will be this 9,650. All this background calculation is just something we do on this table and is based on the inventory method. But in the journal entry, we're only going to be really seeing this output of it, which is this total cost of goods sold for this 140 units that we're selling. So what do we have left over? We basically have, oh, hold on. Sorry, this actually, I'm putting it in the wrong spot, but just for your information, the total cost of goods sold would be this plus this. So actually they're not giving me a spot for that. So rather, what do we have left over in our inventory? We got rid of all 90 of these, and we got rid of 50 of 130 of this layer. So 50 minus 130 is 80. So we have 80 units left over at $76 each. And so that is $6,080. Okay. So now at this point in time, we only have 80 units in inventory. We sold 140. And so now we're moving on to the next transaction, which is another purchase of 170 at $86 each. So 170 units, $86 each. 170 times 86 is 14,620. Okay, so now we have two layers. We have this 80 units at $76 each. And then we have these new units that we just purchased. Okay. So now finally we have a sale of 180 crates at $104 each. So this at $104 each would be important if we were doing the journal entry for the sale, because we would have to recognize the revenue for these 180 units that we're selling and also the cost of goods sold. But in this particular table that we're filling out currently, we don't really need that right now. We just need the fact that we sold 180 units. So with FIFO, again, we're going to take the oldest layer first. So we have 80 units there. So that means we have 100 units left over to take from this 170. So we take 80 and 100 to get to our total of 180. And so this 80 is coming from the $76 layer, and this 100 is coming from this new layer that we just purchased at $86 each. And it says 100. So then what do we have left over? We got rid of all 80 of these. We got rid of 100 of these. So we have 70 left over at $86 each. And so how many do we sell total? 180 plus 140 is 320. And our total cost of goods sold was just the sum of all of these in this column. And then for this, we purchased a total of 300. And the total cost was this plus this. Okay, so let's see how we did. Oh, okay, I think I did some math incorrectly here. That works. Okay. Okay, so what is the gross profit using this method of FIFO? So let's see what our important numbers are. First of all, what is gross profit? Gross profit is your revenue minus your cost of goods sold. So we have our cost of goods sold right here for this period. So what is our revenue? So then we will refer to this table here. So we sold 140 units at $100 each. And we sold this sales transaction here, 180 at $104 each. So this is the revenue for each of these transactions. So we have a total revenue of 32,720. And so this is our revenue. Cost of goods sold we get from here. We have our total cost of goods sold. So now our gross profit is just equal to the difference between our revenue and our cost of goods sold. Okay. Okay, so now it's wanting us to do this exact same thing, but using LIFO. So it's good we have a lot of the calculations done already. So the purchase transactions are going to be the same as above. So let's fill it in. So remember, the methods are costing methods. The purchase transactions are the same for all of these methods. It's when we're calculating cost of goods sold, that's when we have to start thinking about which costing method we're using. So all the purchase transactions, again, are going to be the same between these three methods. Okay, so now we have our first sales transaction of 140 units. So in LIFO, we're going to start with the newest layer and move backwards. Before in FIFO, we started with this 90 and moved forward, oldest to newest. With LIFO, we're going to start with newest to oldest. So the first 130 units of this 140 is going to come from this purchase we just did. So we're going to sell all of these 130 at 76. And then the remaining 10 will come from this $65 tier. And then what do we have left over? We have 80 of these left over because we had 90. We just sold 10 of them. Okay. So again, the purchase transaction is the same as above in FIFO. And now we have this 80. Okay. And so now this next sales transaction, we're selling 180. And so again, we're going to take 170 from this newest most recent layer. And then 10 more to get to our total of 180 from this tier. Okay, and what do we have left over? We had 170 of these, we sold them all. We had 80 of these, we sold 10 of them. So we have 70 left over. Okay, so notice one thing. Our ending quantity is 70. Ending quantity is 70. Because we've bought and sold the same number between these two methods. What is different though is the ending inventory value. So we have 70 units here, we have 70 units here, but our ending inventory balance here is higher than this. And we're going to see here that our cost of goods sold is higher than this. So our inventory balance is lower, but our cost of goods sold is higher between these two methods. The quantities are all the same because we're buying and selling the same amount. It's just we're differentiating on which of the units and at what cost we're using in our cost of goods sold. So the units again are the same. It's just the cost of goods sold and the inventory on hand, ending balance are going to differ. Okay, so let's see how we did. Okay, so again, gross profit, let's go back to our sheet here. Revenue is unchanged. We have the same amount of revenue, but now our cost of goods sold is a different number. So we see our gross profit is lower. It was 8,390. It's now 6,920 because we've changed our method and have a different cost of goods sold. Okay, so now let's do the weighted average. Okay, so starting balance is the same. Okay, so we have this first purchase transaction. Okay, so each purchase transaction in the weighted average method is going to basically trigger a recalculating of the weighted average cost. So how do we do that? We basically take the total cost of all the inventory, so this number plus this number divided by the total number of units. So this is the total amount that we spent on the inventory, and we have 130 plus 90, 220 units. And so you just take the total cost divided by the number of units, and we get 220 units at $71.50. And that's our total cost. So now we have all of our 220 units and one weighted average cost for that. So we don't have to do what we were doing before with all the layering. It's just all been combined into one layer that reflects a price that's weighted by the cost of each of them. So now let's do the first sales transaction and see why this makes a difference. So we're going to sell 140 units, and now we don't have to figure out which layer to use, oldest or newest. We just have already combined them into one number. So just use our unit cost here. And so we now have 220 minus 140. We have 80 units left. So again, the unit counts are all the same. 90, this is 220, 80, 90, 220, 80. The unit costs are all the same. It's just a difference in the cost of goods sold and the inventory value. That's the difference between all these methods. Okay, so now we have another purchase transaction, 170 units. Okay, so now this is going to, again, trigger us to recalculate our weighted average cost. So we have our total cost is equal to this new purchase plus our existing cost. And then the number of units is 170 plus 80. So when we do the division, our per unit cost is $81.36, and we have 250 units. Okay, so now finally we have this sales transaction, 180 units. We have to use our new calculated cost. And you just multiply these two together. And what do we have left over? 70 units. This plus this equals this. The total quantity that we sold is the same as all the methods. Again, 320, 320, 320. But this is different, this is different, and this is different. Same thing with the inventory on hand. It's 70 in each of the three methods, but again, the ending inventory balance is different. The purchase transactions are all the same. 300 and 24,500. That's what all three of these methods are, because again, the method only differs in this calculation of cost of goods sold, which impacts how inventory balances are held, because you're taking the inventory value, you're turning it into cost of goods sold, but the methods vary on how you're doing that. But the purchase transactions are all the same. You're spending the same amount of money for the same quantity of goods in each of the methods. Okay, so let's see how we did. Oh, something's wrong. Okay, it looks like I was just slightly off here. It was 15,370. I put 15,730. So this number is slightly off, but the ending balances are correct. So let's calculate our gross profit. So again, we'll go back to this section. Revenues, again, are unchanged, but now our cost of goods sold. So our gross profit is 8065. Okay, so let's just compare these three. So we have 8,065, 6,920, and 8,390. So clearly, FIFO is the highest gross profit middle is weighted average, and lowest is LIFO. This is, of course, assuming, or rather the pricing is that the purchases are increasing. The cost of the units is increasing over time. So this only works, or rather this relationship between FIFO, LIFO, and weighted average cost is only going to hold when the unit price of our purchases is increasing. If it's decreasing, then it's going to be the opposite. LIFO is actually going to have the highest gross profit and FIFO will have the lowest. But again, typically it's the case that unit costs are rising with inflation. So you're usually going to have the case that FIFO has the highest gross profit, LIFO has the lowest, and weighted average cost is in the middle. Weighted average cost is always in the middle, regardless of if unit prices are increasing or decreasing. Okay, so now the question is, if the business wanted to pay the least amount of income tax, which method would it choose? So income tax is calculated as a percentage of net income. So if we wanted to have a lower net income, we would want to have a lower gross profit. So we want to have LIFO because it has the lowest gross profit between these three methods. Okay, that's it.